Hey, greetings everyone. How y'all doing out there across the internet? My name is Mike the CPA, and welcome to Money and Life TV, where we teach finances, investing, and taxes. In today's video, we're going to explore if my wife and I, did we pay more in taxes under Trump's law, or did we pay less? Let's find out in this fun analysis video. Oh, and by the way, I'm actually filming this video on November 1st. So by the time you're watching this video, hopefully we'll know who the president's gonna be and which way tax laws are gonna go from here on out. What we're gonna do now is look at a spreadsheet on screen, which I've compiled, that contains my previous tax history from 2012 all the way through 2019. Now you can totally do this exercise for yourself if you would like to. All you would need is your previous versions of your filed tax forms, and from there, you can calculate what your effective tax rate is. If you don't know what the effective tax rate means, what that actually means is that is the net average rate of tax you pay on every single dollar you earn. The effective tax rate is a slightly different concept than marginal tax rate, which deals with tax brackets. So it's slightly different. So do not confuse the two. If you want to see the differences, then I'll direct your attention to this video and I'll link it down in this description and comment section below so you can learn what the differences are. But when it comes to comparing a tax plan of a president in office, in my opinion, as a professional, I think the best way to determine whether you're paying more tax or less tax is to focus in on the effective tax rate. All right, here we go, ladies and gentlemen. What you're looking at on screen is tax years 2012 all the way through 2019. Now, the Trump's tax laws under the Tax Cuts and Jobs Act really didn't take effect until 2018. That's when they fully took effect. The columns highlighted in blue here through 2012 through 2016, that was when Obama was in office. So that was during the Obama administration. When we're comparing these numbers, I wanted to draw your attention to a few things as we talk about this. So if you remember, back before 2018, we had a thing known as personal exemption. So you could have a personal exemption for yourself, for your spouse, for your kids, all that and the other. And so for the first several years, that's the way the law was. You would get a personal exemption, usually each year, and this is like the combined amount for my wife and I for those years. And each year would go up, as you can see, just a little bit. The standard deduction back then was much lower than it is now. So for years 2012 through 2014, we took the standard deduction. In 2015 and 16, that's when we had enough mortgage interest and property taxes and things like that and donations where we were able to begin to itemize. QBI deduction is something that did not come into play until the Trump administration. So all that's blank, that row is blank until 2018, 2019. We'll talk about that. And as you can see here, the numbers in green, that is the taxable income amount, or the amount of our income that was actually subject to tax. And the total tax line is how much tax. This is just federal tax. We're not including state tax whatsoever in these calculations. This is purely federal tax law. Lastly, you get to this thing called the effective tax rate. And the way you calculate that is all you would do is you would find this total tax line on your tax form. You'll see it. It'll say total tax. And then I'll show you the forms on screen. I'll highlight where that's at just so you can see it.
To quickly identify these numbers on your last filed 1040 personal income tax return, go to 1040 page 2 to find your total tax amount. This can be found on line 16. You're going to divide that number by the amount found on 1040 page 1, line 11B, which is your total taxable income. Easy peasy, folks. Easy peasy.
But you would take the total tax and divide it by your total taxable income. That's going to give you the effective tax rate. So it's a really easy calculation. You're just dividing two numbers. So total tax divided by total taxable income. 90% of our income comes from wages. Less than 5% comes from investments. And 5 to 7% roughly of our income comes from YouTube, but that really didn't start to occur until 2018. So for the most part, most of our income comes from wages, with a small portion coming from investments. Now, we first got married in 2012, and we were very early on in our careers at that point. And so our taxable income, as you can see here, was far less than it is today. But over the years, because my wife and I both work, the taxable income amount continued to climb as we took new jobs, we got raises, promotions, we had more investment income, eventually we started this YouTube channel, things like that. So you can see that over the years, essentially our taxable income has now doubled compared to what it used to be. And we don't have any children, so we are not able to have the child tax credit, or we don't have any additional exemptions, things like that. So just my wife and I, it's always been that way. And we both work full time, and that's basically what we do. As our income climb, which this is the way taxes work, our tax rate should climb, right? Our effective tax rate, because the tax system is progressive. So the more income you make, the more tax you pay. And you can see our effective tax rate grow as our income grows from 13.88% to, in 2014, it's like 15.5% to 17%, and almost 18% in 16 and 17% in 2017. And that was all before the Trump tax laws came into play. So then they went into effect, and you can see our tax rate actually decreased. And there's a couple main contributing factors to that. So one thing I want to point out is, starting in 2018, personal exemptions were gone. So you no longer got that deduction, right? But to make up for that, Trump raised the standard deduction, which is a set amount of tax deduction every single person gets. They can itemize, or they can take the standard deduction. If you look at 2017, our itemized deductions were $19,500, which clearly is going to be less than $24,000, because as we paid off our mortgage interest amount kept going down. So this total itemized deduction table was going down too, the amount that is. And so clearly, starting in 2018, I haven't itemized since, because $24,000 is greater than anything I could have itemized with. We get a QBI deduction on our rental real estate investment income and REITs, and also from the YouTube channel, because at this point we were starting to make some money in YouTube. And thus our taxable income was actually less this year, because there was a couple of job transitions that occurred. And so there's a lot of stuff going on in 2018. Okay, in 2018, you can see right here on the taxable income line, our total taxable income was roughly $117,000. So let's look back in our tax history, and see where our taxable income was about that amount before. Well, in 2016 was a good place to first compare this, because I had about $117,000 in taxable income here. So they're within $1,000 of each other, right? So it's really close. So I think it's a good comparison spot. So in 2016, my effective tax rate was what? 17.78%, whereas my effective tax rate in 18 was only 15.33%. So that is a net effective rate savings of 2.45%. And there's a couple reasons for that. One was the higher standard deduction. There's the QBI deduction, which was fairly small, but it helped. And one of the biggest reasons I think our effective tax rate went down is, if you remember, when Trump introduced TJCA, the Tax Cuts and Jobs Act, he lowered the average tax bracket by 3% for everybody across the board. So on average, most people paid about 2 to 3% less in tax when it comes to their marginal tax rates. Thus, you end up paying less tax because of it. Now, was that true for everybody? Well, no, we're going to talk about that in just a second. There's a couple things in 2019 I want to point out for you guys. You can see here that we had a significant increase in our taxable income. We went from $116,000 to $157,000. So how big of a difference is that? That our taxable income in that 1 year increased by about $40,000, just right there. But even though we made $40,000 more that year, our effective tax rate only went up about just over 1%. 2019 is obviously the highest taxable income year on the spreadsheet, but the second highest taxable income year is in column 2017, where we made roughly $134,000 in taxable income. If you take the 157 minus the 134, it's essentially a $23,000 income difference. If you look at the total tax line, this right here, you can see we paid about $26,000 in taxes on our income in 2019 and $23,000 in taxes on our income in 2017. But even though we paid more in tax, look at the rates. So the effective tax rate in 2017 was 17.12% versus 16.7% in 2019. In 2019, from a total dollar perspective, we did pay a larger amount of tax, but our tax rate, our effective tax rate on that income, we were more efficient tax-wise. So we paid, on average, we paid less in tax on each dollar earned than we did on our income in 2017, when our taxable income was actually lower. Something I wanted to highlight here with this spreadsheet. From this spreadsheet and having this historical tax data, I think you can see on average that if you're comparing a current year under versus an older year and comparing effective tax rates, my wife and I are probably saving anywhere from 2 to 2.5% under Trump's tax laws. Now, does this mean every person's saving money under Trump's tax laws? No, it just depends. But what I found in the profession is that once TJCA was implemented, most people, most Americans did save money on taxes. They paid less tax or had a better effective tax rate than they used to under the older tax laws. Now what I would like to do is emphasize when people were actually worse off under the TJCA tax laws. There's a lot of people out there who claim that the lack of personal exemptions, once those were removed, that they were paying more in taxes. But I find that not to be the case as a CPA. I find that the increased child tax credit, the $2,000 credit per qualifying child, or the other dependent care credit of $500, pretty much offset that for the most part. Now, there might be a few circumstances where that's not the case, but for the most part, the child tax credit pretty much took care of that. And my effective tax rate would have been even lower had my wife and I had kids, because our income was under $400,000. So that child tax credit didn't really phase out until your income got above that. Being in the profession where I saw Trump's tax plan hurt people more so than others is actually when it came to itemized deductions. So Trump raised the standard deduction from roughly $12,000 to $24,000 for married filing joint. So he nearly doubled it, close to it, give or take. But what he did on the itemized deduction side is take away or limit the amount of itemized deductions you can take in regards to taxes you pay. So the people who had high income taxes got hurt. So like if you were in California and you were a doctor who made like $500,000 or $600,000 a year in wages, and you lived in California, this really hurt you because you were used to paying a lot of state income taxes on your wages in California. And that's one example. The other area is high property taxes. Perhaps you have multiple homes, or you live in a state that is property tax heavy, or that's where they focus the bulk of their tax base on. Well, then you get stuck there or hurt there, because this used to be pretty much unlimited, but now this is capped at $10,000. So that's where it hurt a lot of people. So I used to see, so if you would look back at my spreadsheet, so in 2017, that was the last year that my wife and I itemized. But were doctors out there who I prepared the tax returns for. This itemized deduction number for them, it used to be like, I'm not even joking, it used to be like $70,000, $80,000, even $100,000 for them, because that's how much income taxes, state income taxes they paid. But what happened is the new rules came into place, and it knocked down their deduction from like 70 to 80,000 in this bucket right here to only 10,000. So right away, their taxable income, or the amount of their income subject to taxes, went up like 60,000, even if they were still able to itemize, because of the limits on property taxes and state income taxes. So that's where I saw it hurt the majority of people, is in this area. But those are generally for the higher income earners. So if you made a lot of money, then yeah, those were the people paying more and more taxes, of course, but that's where they were hit the hardest. Another spot on here is where I saw it hit a lot of people is with the unreimbursed employee business expenses. Now, this is a newer form, so it doesn't have it on here, but it used to be if you were like a truck driver or somebody who had a lot of unreimbursed expenses, you might be able to take that deduction. So sometimes people spent thousands of dollars on that, or even tens of thousands of dollars per year in that bucket, but that got removed from this form, and so people were no longer able to do that, and so that hurt people in certain professions, unfortunately, but that's the way it rolled out. So wrapping things up now, in a nutshell, you can see that my wife and I, on average, pay less tax per dollar earned under these new laws, But not everybody was able to escape paying less tax. However, the majority of the population, from statistics and from what I've seen in the profession of doing taxes for a living, most people are paying less tax, or at least have a lower effective tax rate on each dollar they earn under Trump's plan. I wanted to put this spreadsheet together to just kind of, for fun, just kind of see how things have played out. But more so now, since we're right before the election when I'm filming this, it's going to be interesting to see, because I'll do this again next year if you guys want to see it. If, let's say, Biden gets in and how his tax plan changes things, I would like to do a tax rate comparison then and see how much more I'm paying in tax. I hope it's not a lot more, but nonetheless, at least I'll have the history of the spreadsheet to do it. But you can totally do this for yourself, guys. It's really easy to do. You just remember, you're just dividing, you look at your tax forms, you're just dividing your total tax divided by your taxable income to get your effective tax rate. All right, ladies and gentlemen, I hope you got a lot out of this video. Hopefully it was kind of fun and interesting to look at that tax history. I know it was for me putting this together, and hopefully you got some educational elements out of that. It's really easy to compare your effective tax rate, and if you end up digging into your prior year tax returns real quickly, I just would be curious to know whether you've benefited under Trump's tax laws or not. Leave those comments in the comment section down below. I always love when you guys engage in the comments, because that's the best part of doing YouTube. Until then, you know what you guys can do to support the channel. You can just drop a like, subscribe for our upcoming weekly videos that teach finances, investing, and taxes. Most importantly though, live life uncaged. I'll see y'all in the next video. Love y'all. Peace.